What's up, ladies and gentlemen? Thank you for tuning in. Let me tell this music real quick. Uh, I am your boy Chuck Taylor with the Bag Brigade Discord server, Bag Brigade Financial. BagBrigadeFinancial.com is our website. There'll be plenty of links in the YouTube description for this video below, but I wanted to go ahead and make a um, an options tutorial because I think a lot of people have been, asking about that. And yeah, so I figured, you know what? I know a lot of people trade on Robinhood. I know a lot of people hate on Robinhood. I use Robinhood. Um, I think it's still a good platform to use, especially for beginners. But someone like me, I trade on multiple exchanges. I have a TD Ameritrade account. It's for my long term. Got to get the long term, baby. Always, always keep the long term. But I don't like to commingle my long term stuff with my options trading. So I resort to trading most of my options on separate accounts, such as Webull. I use Robinhood, and I've just begun to use public.com because they just opened their options trading. That used to just be stock holding. Really great platform. I'm going to put all the links in the description below. But today we're going to focus on Robinhood, just so it'll give you a better idea. And I can even show you my phone screen to where I can, if you guys trade off your phone, which I typically don't like to do this, but it's if you're on unless I'm on the go, and that's why I think Robinhood's key sometimes. It's just very easy to use. So, with that being said, let's start off real quick by talking about call options. Okay, if you are going to follow along with this video, why don't you go ahead and pull up Apple, okay, on your Robinhood. So you go up here and you type in Apple, or you can type in the ticker AAPL. Cool. All right. And then same thing with the phone. So let me pull the phone up. And what you'll do is it's the same situation. You'll just type in Apple at the top, it brings you to the screen, right? So we're going to be doing it on both of these. So the next thing is that even visible? I don't know. And what the hell? Okay. So here's what you'll do. If you want to trade options on Apple, you go trade Apple options. Now you have to have this unlocked, or like you have to have access to options trading on Robinhood. You have to go to your settings and get it set up. It's not just going to be available. You have to answer a few questions. Yada yada blah, 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 blah. It's really easy. Really easy. Okay, so this is what the desktop kind of option chain looks like for Apple's contracts that expire this coming Friday, the 16th of February, 2024. You have your buy button, your sell button, your call button, and your put button. We're going to focus on calls though. I'm not trying to freak out. And they even started doing this new thing where you can go to this builder and it'll kind of like explain how these different types of options strategies work or are designed. I would recommend staying out of the really complicated spreads, like these put debit spreads, put credit spreads, call debit. I mean, they're safer to an extent, okay, but you're capped on your gains. And I think most everybody who's probably watching this really just wants to, focus on the calls and the puts, the straight one leg strategies. So let's go back to the chain. Now let's pull this up on my phone. Same thing, trade options. So there, boom. See, we're right back here. It all looks very similar. Um, okay. So once you've done all this, whether you're following along on the phone or on um, the computer, I want you guys to understand something. So, like, focus on understanding four specific call options, right? So, let's look at let's see, Apple's currently trading at what, 188.53 is where it closed the day on Friday. So, if you were to be bullish on Apple this coming week, you have a couple of options to choose from here. You have the 190 call option. Okay. You click it, it's going to give you all the data. You're going to have your volume. That's just going to show, okay, here, let's start like this. Open interest. That's how many contracts of this specific contract are out there being held by individuals. volume. This gets updated every trading day. So 62,000. Those contracts are switched hands 62,000 times. So I usually like to see a lot of volume and a lot of open interest. It just helps with liquidity. It helps getting filled on what you're trying to do. And see, same thing on the phone, you'll just click the 190 call button right here. It's going to pull up all the statistics. You can add it to your watch list. And we're going to go through all of that. But let's get to the basics though. A call option is essentially a contract between a buyer and a seller. Because no matter what in the stock market, or if you're selling something, there's got to be someone on the other end buying it, and vice versa. If you are buying something, somebody is selling you that. Whether it's a stock, it doesn't matter. There's always someone on the other side of the transaction. Um, and we're just going to focus on the calls right now. So um, what a call option actually is, owning a call option grants you the right, but not the obligation to purchase 100 shares of the underlying stock, which would be Apple, at a predetermined price, which would be 190 that we're talking about here, known as what is called the strike price. In this scenario, Apple is the underlying stock. Like, so now, like for instance, let's say you get this 190 call option, right? This means you buy it right now for $1.37. Now you have to multiply that. That's in premium terms. You have to multiply that number by 100. So basically, that's $137 because there's 100 shares attached to each contract. That's kind of what I was explaining earlier. Like it gives you the right, so it represents 100 shares. So each share, you're basically paying a premium to hold this contract, $1.37 per share. Since there's 100 shares associated with it, it's going to be $137. Now that price will change when the market opens up on Monday, depending on where Apple opens up. It could be higher or lower. I'm not sure, but that's just to give you a good rundown. And I'm sure most of you already know this. Um, so the 190 call. This means you have the right to buy 100 shares of Apple at $190 a share. This process of purchasing shares at the strike price is referred to exercising your call option. Um, if the current market price of Apple is higher than 190, or higher than the strike price that you chose, which would be 190, you can buy shares at a discount and potentially sell them for profit immediately. Now, I know a lot of us, I know a lot of people don't really like to exercise. We don't really exercise. I don't really exercise unless it's absolutely necessary or it just makes sense to do so. But we're trying to flip premium here, right? So we don't want to hold on. We're not trying to buy 100 shares of Apple because it's going to be expensive. It's going to be expensive. But it's what these were designed for, basically. Options were basically designed as a hedging tool in a sense, but I'll get more into that. So, options where the strike price is lower than the current share price are termed, or in the terminology is going to be in the money. Like if Apple is trading at 195 and you're holding the 190 call option, your option is now in the money. Okay. Uh, it presents an opportunity for profit upon exercise. Again, we're not exercising this stuff. Unless you want to. Conversely, the option strike prices equal to or that are higher than the share price are called at the money or out of the money. I would say this is about as close you're going to get to at the money. These two right here. Now, this one's in the money a little bit. This one's just outside of it. So these are your at the monies right here. I like to consider these two the at the monies, like right in between where the share price is, the one below, the one higher. You'll notice that as it gets deeper in the money, look at the value of these contracts, right? So that's the whole point. You can buy for $137. If Apple goes up to 195, that contract could potentially be worth, $500 a contract. It really just depends. There's a lot of factors when playing with options. The thing about out of the money options is it's risky. Okay, but I know a lot of us play it because they're cheaper, and honestly, really you just need the underlying stock to kind of perform in your direction, especially if you have enough time before expiration, and you should see your premium price gain value, even if it doesn't go to 190. It just needs to head in that direction from when you bought it, and um, you'll see the premium price. You've gained value, and then you can sell it whenever you want. See, that's the thing. We flip premium. We flip premium, fam. We flip premium. We don't exercise. Okay. So the value of the call options can fluctuate based on various factors, including the movement of the underlying stock price. As the stock price changes, so does the value of the options, like I just explained. If the stock price rises, the value of your call option typically increases, allowing you to sell it at a higher price or pocket the difference. Understanding these types of concepts, call option, strike price, premium, in the money, at the money, out of the money, and underlying, lays sort of as like a solid foundation for grasping the dynamics of trading call options. But take your time to absorb these type of fundamentals, as they are definitely essential for navigating the world of option trading. So on the 190 strike price, right, on Apple, uh, I favored this option because basically, now it is expensive, I get it, but it's definitely a safer bet because you're super close. Because what you don't want to end up happening is you buy the 195, right? Yeah, it's $26. What do you do? Now, if Apple does go to 195 within the next week, I mean, that's great. That $26 could turn into several $100, especially if it goes even higher than that. Okay, so here's the option. Perfect. Awesome. You can see its history too. So let's see, it closed the day at 126 or $26 a contract, 26 cents a contract on the 3 o'clock or 4 p.m. Eastern time on Friday. And since it's the weekend, it is closed. But at one point in that day, that contract did reach a value of 47 cents or $47. So if you had bought it at 26, that's obviously because Apple went on some sort of run in the middle of the day there and went up. It didn't reach 190. Maybe it did. I'm not sure. But either way, and you can go back and look at the history of the option, right? So back in, maybe a week or so ago, this option was trading for about a dollar a contract or $100. You guys can start to see where you can make some serious dough doing this. I mean, look at this. I mean, look at the price on this one. It's the same option. This is just over time, and this is where you start to see the time decay, what we call theta. And that's part of the Greeks, and we're going to get into that. But as you get closer to expiration, the contract significantly loses some of its value. And that is why buying weekly options or 0 day expiration options, 0 DTs, whatever you want to call them, on the ETFs like SPY, QQQ, it can be very dangerous. It can be very lucrative. They're cheap, but the chances of them going to zero are higher than not. Okay, that makes sense. But they have done this thing where you can simulate your returns. And I think this is kind of cool. I use this other uh, website called Options Profit Calculator. I will show you that, but this is something new and I'm not too familiar with it. But I think it's basically saying, okay, simulated returns. Okay, so let's say we get Apple to go to 191 by the 14th. Well, no, we want 191 by the 12th, right? Well, either way, this should show you. Okay, here we go. See, if Apple goes to 195, this one contract. Now this is estimated, and here's your timeline, right, till expiration. So if it were to go to 195, 70 immediately out the gates on Monday morning, and you'd buy it like immediately, because you can't. The options won't trade in pre-market or aftermarket, so it is literally 9:30 a.m. Eastern to 4 p.m. Eastern. That is it. Unless you're trading QQQ, SPY, like ETFs, exchange traded funds, they will allow you an extra 15 minutes after the close. But just those. If it's an equity, that's the only time these prices move. So if Apple moves up and down in pre-market, it could affect you if you're holding overnight. Maybe in a good way, maybe in a bad. Hopefully that makes sense. But either way, so you bought it for we're looking, I think it was $1.27 or something. If it goes to let's see here on the 12th, so that's tomorrow, right? Yep. Okay. At open tomorrow. If it's anywhere near this price of 195.70, this is kind of where you can expect to see the value of that contract, and you can see over time as the time decay does kick in. Now that it's in the money, since I put the price here, it's not going to go to zero, but Robinhood will sell. They will execute. They will go ahead and sell off your contracts if you're still holding this contract and it's anywhere close to the money. They will. They have the right, and they will offload your position if you do not have enough money in your bank account to buy 100 shares of Apple at $195. What is that? 19,000. Okay. So if you don't have $19,000 in your brokerage account, then they're gonna sell it off. Okay, so that's just how that works. I mean, it makes sense to me, but like just again, now look. So if it goes only to 193, okay. See, you can see how it's different because you're going to be in the green, of course, because it moved up, right? But as you approach your expiration date, it's the option is still not in the money, and then eventually it will go negative, and then eventually it goes to zero. I mean, it can go to zero. It just depends. I mean, you got to use risk management. Today, I want to kind of explain to you how, like, why is it priced like that? Why is $1.37 the $137 the quoted price on this contract? And that's what I'm going to explain. So basically, these at the money contracts, the premium is going to be, like I explained, $1.37 per share, but you have to multiply it by 100, so it's $137. So the premium consists of two components, okay? And these are important to understand. You have your intrinsic value and your extrinsic value. Say that with me. Intrinsic value, extrinsic value. Do not get intrinsic value confused with IV, because IV is something you're going to hear a lot, and that is actually referring to implied volatility. Nobody's going to call intrinsic value IV. They're talking about this right there. Okay, just as long as you understand what intrinsic value is, it's the intrinsic value. It's relies on the underlying stock's movement. Extrinsic value, okay, extrinsic value, which is the remaining portion of the premium, basically the value accounts for factors beyond immediate profit, such as time to maturity, the implied volatility. See, there's that IV. Time to maturity refers to the duration until the option expires. The longer this period, the higher the extrinsic value. As there's more time for the option to become more profitable. The less time, it's cheaper, and it's not giving you you don't have a lot of runway to get to your strike price. So that's why as you move further out in date, add more time to the contract, like you go out a month, you're going to see that same, like now that 190 is trading at $4.05. It's because time is value here. Okay. So that's the extrinsic value, basically. It's not 100% reliant upon the move of the underlying. It's the other factors, the theta, the time decay, all that kind of stuff, the implied volatility. What that means, implied volatility, we're going to talk about that. If your contract, when you bought it, and I wanted to go more into this in separate, but just let me talk about it real quick, has an implied volatility of 20%, just about a little bit over. That's relatively safe. I mean, if you look at Tesla contracts like Nvidia, I mean, some of those things are like hundreds of, maybe sometimes 1,000%. It just depends. But that's showing you where the market maker, the one who's writing these contracts and selling them to you, is in basically that's how they're pricing in this premium price right here, because it's basically pricing in saying this is going to be a volatile stock, like during earnings. Okay, like these are good. This implied volatility could be extremely high due to the fact that earnings typically makes most equities move in a certain direction, you know, uh, up or down pretty violently. So that's priced in, and that is going to affect your implied volatility. Meaning, I would bet that this Apple's doesn't typically get very volatile, but I would say, they were probably, those contracts for their earnings about a week or two ago were probably closer to 100%. So you have to keep that in mind. because it can help you in a sense, but it can also screw you over because you could be extremely right. Like if you bought Apple contracts before their earnings, right? Like right before close, the earnings were about to come out, and you went pretty deep out of the money. And you'll see that the implied volatility gets a little higher as you move. Apple's a bad example though for this, because it's a little bit more. You know what? How about this? Let's do Tesla. Give you guys brought to you by Tesla. Now Tesla. Okay, yeah. See, they're already on weeklies. They're at 46%. That's because Tesla is extremely volatile, and you can it's reflected in the price of the premium, as you can see. I mean, it's basically priced the same as Apple, but look, one strike price at the money, you're paying double basically what Apple was because the implied volatility itself was is higher. And what can happen is if you get into it with low IV, low implied volatility, let's say 20%, and all of a sudden Tesla like drops some news and you're holding these contracts and Tesla goes up like crazy. Like let's say it goes from 193 to like 210. Okay. Um, well, your implied volatility, first of all, is going to jack up. It's going to go up like crazy. But the fact that you bought it at 20% implied volatility and it goes to like 150% implied volatility, that actually boosts your premium. And Tesla doesn't honestly have to move that much. It's just the market maker is implying like, hey, like there's a lot of demand for this contract. Like it's volatile, so it actually can help. There's been times where I've made money off of actually the stock not really moving all that much in the direction, but it was just the amount of inflow and it was due to news dropping to where the contract actually gained value just because of the demand, basically is how I can put it. There was so much demand for it that the value went up, even though Tesla didn't, or whatever, the stock didn't move. But in this case, we're talking about Tesla. Hopefully, this makes sense. Kind of like run and play around with these options a little bit. So, all right. Um, so again, regarding the implied volatility, I mean, like I just want to recap real quick. Increasing volatility does boost extrinsic value, while decreasing volatility diminishes it. And that's called IV crush. Meaning, if you bought a contract, let's say you bought a Tesla contract, 205 call, you got a 50% implied volatility, pretty deep out of the money. But for Tesla, Tesla does move. But and then basically, if let's just say, uh, let's just say it was trade, the implied volatility was like at 150%. Okay, and you buy it, and then the next day they have their earnings, and the earnings went well. It actually moved up the stock to about 202.50, right? But didn't quite hit your strike, right? Well, the implied volatility the next day is going to, when it opens up, that implied volatility percentage from 150, or let's just say it was 200%, could easily drop to right where it is right here, about 50%. That is called IV crush. You could be so right and almost to the money, but yet not close enough. And the extrinsic value gets crushed because the IV, or the implied volatility, has been substantially reduced. And that does affect the price of your contract. So you have to keep that in mind as well. That is more of a swing trader thing, really. If you're day trading these options, you don't really have to deal with that so much because you're not going to hold it overnight. You doesn't, I mean, yes, you're kind of in and out. So you don't have to kind of focus on those things. It's really for more of if you're going to hold it overnight or a few days or weeks like you. Understanding premium involves grasping intrinsic and extrinsic value. Okay, intrinsic value, boom, all it is underlying. It's all related to the movement of the underlying stock. That's it. Basic, yeah. So if it goes up or down or stays stagnant, that's your intrinsic value. The extrinsic value is everything else we just talked about. Like I said, it's recognizing it's basically the applied volatility. It's the theta, which is the time decay. You know, it's going to be the implied volatility. It's going to be basically everything is here right here, and this, and all this stuff. extrinsic value, extrinsic value, extrinsic value, extrinsic. These are all extrinsic things. The only thing that is intrinsic is this, the share price of the underlying. So as long as you understand that, let's move on. I'm going to dive a little deeper into implied volatility again one more time, just so this makes sense to you, okay? We'll go ahead and pull up Tesla, brought to you by Tesla. And it's on a really high time frame right there, but okay. This is the 1 hour chart on Tesla. This is TradingView, people. And as you can see, it's pretty volatile. And it's been getting hit. And this is, I think, was this due to their earnings? Yes, this was due to their earnings. They've just been getting hit pretty hard, but it looks like it wants to rebound right now. But anyways, so I'm just trying to give you an example. This is a volatile stock. Okay, that's why the implied volatility is always going to be a little bit higher on Tesla. So at certain levels on the chart, like I said, picture the stock chart exhibiting fluctuations, indicating volatility levels. As you can see, volatile, volatile, consolidation, kind of volatile, really volatile. It's just so that's close enough. Okay, so that's where that's the call that we bought. And we only got till the 16th, I believe is the expiration. Yep. So you got about this much time to get it from here to break even, basically. Not even be in the game. So it just depends. If your contract basically goes worthless, it's not going to say it's worth 0 cents. It's going to say it's worth a penny times 100, which is $1. That's just how it works. If your option says it's only worth 1 penny, that means it's basically worthless. And the only way you're going to get value back is if Tesla were to skyrocket within the next, immediately before, because you're so close to expiration, it has to get in the money, or to even come close to breaking even. So you'll never go to 0 completely, but basically, yes. If you're looking at something that says a penny, you, my friend, are SOL. There is no getting that money back, especially when it expires worthless, because it is not a stock. You can't just sit there and hold it. You made a bet that the stock was going to go to a certain price, and you were by a certain time, and you were wrong, and you held, keeping your hopes and prayers that it might make it, and here comes Friday, and all of a sudden it's worth a penny, and then market closes, and it just expired worthless. That's the danger of options trading, is there is no chance of getting it back when you're wrong. Now there are plenty of benefits to it. That's just one of that's one of the dangers of it. And if you don't understand what you're doing, it's very easy to lose money in this. You're gonna lose money. I mean, it's possible not to. I lost a ton, you know. But basically, look, implied volatility reflects market expectations of future stock price movements, if that makes sense. Okay. When traders anticipate increased volatility, like demand for options rises. Obviously, that's what I was saying. Like it's a supply and demand thing. I have to harp on IV, implied volatility, because it's very important. I think a lot of people overlook it. Again, if you're day trading, it's a different story. And I know a lot of people are day traders, so they don't even really need to look at that. It is going to make the option more expensive to buy, but you don't have to worry about getting IV crushed if you're not going to hold it to the next day or whatever. So it's applicable, but not to the fullest extent. So now let's gauge your comprehension for a second here. I'm going to stop. I'm going to ask a couple questions. You need to be able to answer these questions, in my opinion. Why is volatility beneficial for options trading? Okay. Question number one. I'm not going to answer these. You can put them in the comments. Number two, how do option premiums respond to changes in implied volatility? Okay. And number three, why is it even termed implied volatility? Just think about that. So again, let's say I wanted to buy. Let's go ahead and add this to the watch list. And we're going to come back down here and click on this Tesla. Okay, so this is what Tesla was doing. This is what that option, was it the 205 call? Yeah, this is what the 205 call was doing on Friday. As you can see, it's actually slowly been gaining value if you bought it about a week ago. I mean, not too shabby. Obviously, it's kind of has its peaks and stuff. But Tesla's been going up. Now, if you go back a month, Tesla's been getting absolutely crushed. Do you see how expensive this contract was at the beginning of January, about a month ago or so? $34.80 a contract. Okay, let's try that again. 3,480. That's what that is. So you can kind of see how first of all, when Tesla, if on this call option, Tesla's getting hammered, to the ground, and this thing, Tesla got crushed. So this contract lost a lot of value very fast on their earnings right here. But if for some reason Tesla had done well on their earnings, this contract probably would be worth, somewhere up in this range, maybe in the 1800s, and right now trading for 100. So you can see how you can make some serious gains, especially if you're holding on to multiple contracts. But option statistics, and that's down here again. These are your option statistics right here. And let me pull my phone back up. Oh, sorry. So if you're navigating on desktop, which I don't know how many of you trade on Robinhood on your desktop, but on your phone, remember you pull up you go to Tesla, you go to trade options, okay, and we're going to go February 16th. You pull up the 205 call, which I already have checked on the computer, obviously, but you can click that. There's your option statistics. And we're going to go through this. So we're going to start with the bid and the ask. Bid, ask, and then you can see it on the phone right there, right? Cool. The bid represents buyers' willingness to purchase at a certain price, okay? While the ask represents the seller's asking price, in a sense. The difference between the bid and the ask, known as the bid-ask spread, reflects the cost of immediate trade execution, with the spread amount going to exchange as compensation. Basically, let's say the bid was okay, so you got bid and ask at 100. Bid is at $1, ask is at 103. So they're marking this at the mid price or the mark price at 102. That it's in the middle between those. I mean, technically it probably should be 101 some change, but that's just how they're pricing it. Okay, you got so that's your mid price. You can see that also on your phone, the mark. You also can see what it last traded for when it closed, which was $1, $100, whatever. You got your implied volatility right now sitting just under 50%. The previous close before that, the contract closed at 82 cents, $82. So actually it gained value. It reached a high on Friday of $1.31, and its low is a 78. Your open interest. This is about 14,000 contracts out there in the open market. And on Friday, these contracts changed hands about a little over 30,000 times. So again, more volume and more open interest, the more volatile things can tend to be, but not always the case. You just don't want to find options that have like very, very low liquidity in them. Like I'm talking like zero volume or very minimal volume with a small open interest. It just can get very hard to get filled at a good price and also exit at a good price. You have to be careful. I mean, it's almost like it's the derivatives market. It's its own market, the options market. It literally is. It moves in its own ways. It's not just reflective, like I said, with the intrinsic and extrinsic value. It doesn't just reflect the stock price. Okay, there's other factors, and these are the option statistics right here. Now, the Greeks are going to be the most confusing part for most people. I'm going to try my best to explain them to you. But okay, well, anyways, when trading options, it's important to keep all these into consideration, right? The tighter the spread is, or the midpoint, whatever on the mark price, because it's a tighter spread indicates lower transaction cost because there's so many, the spread is just not there and you can get filled really easy. While a wider spread, like if it was say, I don't know, 80 cents to $1.03, well, then your mark price is going to be somewhere around 90 something cents. But there's a gap, right? So you might actually have to pay, like, up your price to get filled because people are lining up to buy it at this price, and this is what they want to sell it at. It's putting your price in the middle. You may get filled, but if you don't, you can always just adjust it by like a penny and see if that, helps you get filled. Um, that's just kind of how this works. Just you could put it in for, the mid. It's going to do that for you automatically anyway on Robinhood. You can adjust it like 103. But if you want to just go with what the mark price is, sometimes you'll hit buy, and it could fill you at a better price. It really could, but typically expect to pay the 102 on the mark. It just depends on the underlying you're playing. So let's go to the Greeks. This is the more technical part. So moving on to the Greeks down here at the bottom. Is that blocking it? Nope. Okay, cool. Awesome. So these metrics, these Greek metrics, they basically quantify the impact of various factors on your options pricing. Everybody see delta down here? It is at 0.1730. You can see it on the phone as well right here. You can see where I'm putting my thumb, but bottom left. And delta measures the change in the options price per $1 move of the underlying stock price. Yes, I just said that, but it allows you as a trader to see how much market exposure / shares they have the right to. Delta can also be viewed as the probability of the option expiring in the money. So, for example, let's use Tesla, okay? The delta, what did I say? 0.173. So, if you do it like that, therefore, for every dollar increase in the stock price, the option value will increase by 0.1730. Uh, so delta can be viewed as the probability of the option expiring in the money. So, for example, given this Tesla 205 call that we're looking at, the option has a 17.30% chance of expiring in the money. Let's talk about gamma. Gamma, everybody loves gamma. Gamma measures the rate of change of an option's delta, basically. So, given a $1 move in the underlying stock price, so gamma is highest when the option is at the money and lowest when the option is far out of the money. For example, if a long call option has a gamma of what's the gamma on this? 0.0227, and a delta of basically 0.17, and the underlying moves up $1, the option will then have a delta of 0.273. Yes. If this underlying stock moves up $1, your delta will increase by, you just need to add basically 10 basis points to it if you're looking at it from a percentage standpoint, right? So it would, if Tesla moved up to 194.51, that delta will read 0.2730. Okay. Hopefully that makes sense. These are just ways to measure. But again, gamma just measures the rate of change of an options delta given for every dollar in the underlying stock. Remember, gamma is the highest when the option is at the money and lowest when the option is far out of the money. OTM, out of the money. ATM, at the money. ITM, in the money. You'll see and hear this stuff all the time if you start trading options a lot. That's for sure. Let's talk about our best friend over here for option buyers, theta. This is basically how you can calculate your time decay, how much value typically you can lose from time decay. So, theta is the amount of value that disappears from an options price each day. Theta benefits more of the option seller, the one who's selling you the option. They want your contract to go to zero because you've already paid them the premium, like you bought this contract, and it's in their best interest for this thing to go to zero. That means they don't have to supply you back any more funds. They've held on to your money and yours went worthless. They call that the theta gang. There's the option writers, the scammers, the market makers. No, I'm just kidding. There's definitely good sides to selling options. Um, Again, options were designed as a hedging tool at the beginning, and I'll have to get into that later. But basically, the way you calculate theta, um, so this theta right here is negative 0.22857. So let's multiply it by 100. I'm not going to do the negative, but 0.2857. Okay. And that gives you $28.57 if Tesla literally were to just stay stagnant, not move at all, stay right at its price, right where it is right now at 193, and you're holding on to the 205 call. Basically, your contract is losing $28.57 every single day. You can get even more granular with that and see how much it's actually losing per hour if you want to. So 28.57 divided by 24. Well, now you're looking at about $1.20 for every hour if it stays stagnant. Now you can get as granular as you want with that, but we don't need to get that complicated. Just understand that is how you calculate your time decay. If it's an extremely crazy number like negative 1 point something, like either it's you're buying it on the day of expiration or like the implied volatility is legitimately off the charts. Okay, let's talk about Vega real quick. So Vega measures the change in an options price given a 1% change in the implied volatility. No, I just want to confuse you guys with this. Okay, for example, any option with a Vega, okay, we're going to say that is 0.0588, you will lose about $5, and remember, just multiply it by 188 cents for every 1% increase in the implied volatility, or decrease, sorry. See what I'm saying? So that's how you can actually kind of calculate, okay, if implied volatility drops, for every 1% it drops. If you bought it at 49% implied volatility, and the stock or the implied volatility then drops 1%, your value of the contract, 0.0588 times 100. Yeah. So there goes $5.88 for every 1% of implied volatility that decreases, and vice versa on the increase side. So that's, again, going back how you can actually benefit from implied volatility, again, but it also can hurt you very badly. This is kind of where the term IV crush comes from, exactly, from dealing with big events like earnings and all sorts of things like that. You'll see IV climb and the options gain value, and then the next day after earnings drop, boom, the following day, literally the IV could be cut in half. Now think about that for a second. If this IV gets cut in half to 25%, what did I say? 588? Okay, so times 25. Yeah, we're going down 25%. You just lost $147 worth of value. But how's that possible? That doesn't make sense because the contract was only worth 102. It's not gonna. Basically, that means your shit went to zero because you got IV crushed and you're out of the money. That's what that means. So hopefully that hopefully that helps. Hopefully you guys understand a little bit how that works. The one option that most people kind of tend to ignore is RHO. And Rho basically, and it really is probably the most overlooked one, it quantifies the impact of change in implied volatility on an options premium. Say that with me again. Vega quantifies the impact of changes in implied volatility on options premium, showcasing the sensitivity of option prices to volatility fluctuations. So rho measures the effect of changes in interest rates on option pricing. Although its influence is typically minimal and honestly it's disregarded, and that's why I didn't want to harp too much on that. So hopefully that all makes sense. I mean, honestly, here you go. The main things you want to really pay attention to are honestly going to be these three. Actually, these four, but here's your time decay. Multiply that by 100 with the negative sign. That's going to give you an idea. And then you can multiply that number by 24 to show you how much you're going to potentially lose a day if it stays stagnant, and how much it's going to, and you can even go down to the minute or the hour, whatever. Again, not such a implied volatility and theta, not going to be the biggest thing that day traders are worrying about unless they're literally buying 0-day option contracts that expire the same day and they're buying like almost damn near the end of the day. Yeah, it can become a little tricky. That's why some brokerages won't let you open up new contracts, 30 minutes right before the close. It's just how it works. Remember, gamma is how you measure the rate of change of the options delta. Remember that, okay? And then the delta again measures the change of the option price per $1 move in the underlying stock price. Got it? And then again, Vega measures the change in the options price given the 1% change in either direction on your implied volatility. These are just all things that are good to, understand if you're going to trade options. You don't have to live and die by them, but I promise you, the more you know, the better of an option trader you're going to be. All right. With that being said, I want to do a couple just some questions I want you to ask yourself. Okay. One, what do the bid and ask prices represent? And why is the bid and ask spread important? Suck that in. Cool. I'm going to ask you another question. How does volume affect the bid ask spread? And why is open interest significant? Okay, let that soak in. Explain the concepts of delta, gamma, theta, vega, and rho. Honestly, I think if you can just pin down delta, gamma, theta, and vega, if you can't even do four, delta, gamma, and theta. And I would start with theta, gamma, and delta, just so you could. I look at theta first. I want to see what the time burn is going to be, number one. Then I look at, delta. Well, because basically it's telling you how much of a percentage chance of your contract is going in the money. I would like to see a, you know, a higher delta because that means it's gonna go in the money or has a better chance of doing so, right? And then gamma is again. So just ask yourself these questions, and I'll have the answers somewhere for you in the description. And if you guys use Webull too, by the way, which I do, you can go to your watch list and you can pick old Tesla right here, and you can literally go to the option chain like that. Calls are going to be on this side, and they need to go this way, starting from the highest number, and these are all puts. So these puts are all in the money. These are calls way out of the money. Now we're going to go down to actually where the stock's trading. This gives you a pretty good broad overview of how options like the option chain really looks besides on Robinhood or whatnot. It's just I think a lot of people find that Robinhood is just easier to navigate, and I like to do this, by the way. I like to keep open interest, and I like to put the mid price at the top and then the bid and ask. That's just me. But anyways, yeah, you got your Greeks on there, everything like that. You can scroll either way, look at them. But yeah, so you can literally look at the option chain right here. Like I said, out of the money calls, at the money calls, at the money, and in the money calls. As you'll see, and this helps you kind of see it a little bit better. Like as you see the implied volatility starts to ramp up as you get further out of the money. And it also, in a weird way, it actually does the same thing when you're deep in the money. But that also has a lot to do with because there's not a lot of open interest and volume on those because nobody wants to buy an expensive, deep in the money Tesla call. It just doesn't make sense. I mean, you can do it, but I don't know why. Same thing on the put side over here. Um, your mid price, and then the further you get out of the money, same concept. That's Weeble though. That's for a different story. If you guys, I'm gonna have links to all these brokerages, but they do have really cool option statistics as well. I do like it. Like, so you can see right here, um, there's a shit ton of volume on the 192.50 calls. Um, Actually, it's the highest one there is. Yep, and then the same put strike price as well had quite a significant one. Then you had the 190s, so there was a lot of 190 puts that were traded. This just goes down the list and kind of shows you, where traders are placing their bets, and then usually they're going to be closer to the money. And it does give you some pretty. That's kind of cool. So yeah, I mean, it just tells you about the volatility levels, historic volatility. As I was kind of saying before, right, you can probably get a better way to look at this on TD. And then here's your volume distribution. Meaning ask or above the bid, or like the bid. Here's the bid or below. Like that's what they picked them up for. And then between the market, meaning you got them at the mark, or you bought at the ask or above it, or you bought at the bid or below it, or at the middle. So, anyways, don't want to get too technical with you. Go back over here. Okay, convergence is a critical concept in options trading. You don't really hear the word enough, but I mean, I don't know. Anyway, yeah, right here. So that's what this is. What it's saying. It's your premium diagram or your profit loss diagram, whatever. But there's also a really cool site called Options Profit Calculator. I highly recommend everybody use this. So you're going to go on a long call. We're going to type in Tesla. It's going to give you the price where it currently is at. I think that's accurate. I mean, stock market's not open right now. So, but anyways, now you are literally want to buy, right? You're buying. You're going to select the option. That's the expiration dates that we're looking at this Friday, the 16th. And these are your calls. These are your puts. And we were looking at the 205s, right? There you go. See, and like at the mid. So boom. Let's just say we grabbed 5 of those bad boys at that price. Okay. And now we're going to go ahead and calculate and see. And you can switch around with this, but let's see, profit loss. So right away tomorrow, if Tesla opens at 194, now granted, you have to think like you bought this contract on Friday, so you've been holding it over the weekend. So the time decay has taken a little bit of an effect here. But so you technically could be down about 50%, but I'm not 100% sure about that. It's hard to gauge just because it's over the weekend. If the market was open right now, I'd definitely be able to give you a better idea. But either way, this just helps illustrate like, hey, like here's how much money you can make, and obviously the most you can lose is 102 a contract times 5 because you bought 5 of them, right? Let's just say Tesla opens up and rockets on Monday morning. Okay, that goes all the way up to 205. It hits your strike, right? Well, now those 5 contracts that you spend about $500 on should be worth somewhere around 1,400 bucks. As you can see, the higher it goes, and the further away from expiration, the more valuable that contract is. Like you can see how the value does drop every day it gets closer to expiration. So keep that in mind. But the other good thing about options is call options, buying call options is the most you can lose, or put options. The most you can lose is what you bought in for. There is nothing more else to lose from it. Now, yes, that sucks. But on calls, let's say Tesla went crazy, went to 230. This is extreme. Okay, but let's say it pulled a Nvidia. Now do you see why options is very attractive, right? Look at that. Look how much money you can pull out of this, right? But that's a parabolic move. I mean, that's absolutely, but it just helps give you an idea. So options profit calculator, I will put the link in the description. But you can also mess around with it like this, like, percentage of risk. It'll adjust the chart for you. Or you can even look at it like this. I mean, it's a really good tool. It really is. So hopefully that helps, guys. So that's basically what this is. Robinhood's version of options profit calculator. It's helpful though, right? It's helpful. You can do it on your phone too, by the way. I'm pretty sure. Yeah, you go here and put it on the watch list, and then we come down to here and there you go. You can simulate it. Yeah, right here. So, see, as Tesla rises significantly in price, well, boom, there you go. Play around with it. It's cool. It's cool. All right. I'm going to bring it all together now. Let's get back to the chain. And so let's say, okay, hey, all right, I'm ready to buy. I'm ready to buy, right? So you open this up and you click right here, boom. There you go. So you got a long call and you're ready to buy it. Okay, so you hit continue. Now you have to have obviously the right amount of buying power in here. My account doesn't because I do not trade on this right now. But you could put in whatever you want, about 5 of them, yada yada. It's gonna tell you your price right here. You can do, stop limit orders and things like that, but just I'm keeping it basic. Then you'd hit review order. Now I don't have enough buying power, so it's not gonna work for me. But either way, then you say confirm and boom, there you go. And then you'll own that contract. And then when you want to exit it, for instance, I'll go to my stupid UNG contract that I'm stuck in because they did a split, or like a reverse split. I screwed up the entire option chain. It's really weird. UNG is United States Natural Gas, but um, I bought 5 contracts at 20 cents a piece. Then they did like 3 weeks later, they did this like stock split. Now that the underlying is trading at like 20 and it was at 5. So basically I was betting it going to $10. Well, now it's trading at 20. That means it would have to go to 40 and natural gas has just been getting clapped. But you can see, this is kind of a good example. Actually, I'm glad I'm showing this to you, how even though the price of UNG has dropped from 20 to $17 in just like a week, the contract still like will gain this some sort of value to it. It's because the fluctuations between the bid and ask. Like, look, this thing has 2,183 contracts waiting, or 2,183 people willing to sell or buy or at this price, right? Nobody's picking up anything for $0. But the funny thing is look at this. I mean, this is the most weird. This is a weird situation. I'm in kind of in limbo, la la land with this one because you can't even buy any more of these. It's impossible to buy this contract because it's UNG1. It's a weird thing. But anyways, the point I'm trying to make is even though the stock's gone down, the implied volatility in the middle of the day, if that bid and ask change, if there's any sort of type of interest or demand on this side and you see it on this side, that's why you see these like little spikes, right? So, but if I were to come in and try and sell my contracts at that price, that middle mid price right there between, it's going to shoot it. It's going to change the entire dynamics at that point of the contract. Like that, you put in a sell order for the mid price. Well, then it's going to probably drop down to like 5 cents because that basically messes this up. That changes this. I just put in a sell order at 11 cents when all these ask are at 12. So it's going to adjust it, and it's tricky. Try to stay away from low liquidity. These expire in 6 months. I'm not even worried about it. I kind of just want to get out of them though, but I don't even know if I'm going to possibly be able to do that. But whatever. It is what it is. Try to stay away from low liquidity option chains. Now, I didn't know they were going to do this stock split either, so whatever. All right. Well, anyways, going back to, and again, like on the phone, like I said, you can. Let me just go back to Tesla real quick. And there's all sorts of other strategies. Like I'll do this in a separate video. This is just focusing on calls right now. Um, so we went over on how to, buy it, and then again, like if you want to sell it, I guess I got to go back to my UNG one, but yeah, you would just sell, put in the order of contracts that you own, and then you can put in your limit price. Normally, in another situation like Tesla, you basically your limit price should usually always be the mid price, and that's what it's going to price it at for you anyways. Um, and it'll even let you know like likelihood of getting filled, whatever. If you have to adjust it by a cent or something to get filled, so be it. Just $1. But yeah, that's basically how that works. And same thing with the on the phone, right? So trade view all options. Okay, we're gonna buy this, cool, and then continue. And same thing, like okay, we're gonna buy 5 of these. Okay, boom, boom, boom. You hit review. I'm not gonna say it's gonna say the same thing for me. Then you say, okay, cool. Now today's Sunday. You will not get filled on this contract until it opens up on Monday morning, and the price could be completely different. So just I typically don't want to put in an option order over the weekend and like wait for the market to open, just like see what happens. I like to see what things are doing first, before I even uh just place an order over the weekend. Like why would you do such a thing? Makes no sense. Um okay. I hope that was informative. I think I got through most of the basics on it. I mean, like you could type in any stock you want, like even like I'm just gonna get, the all-time hero Nvidia. Woohoo! So boom, you go trade options. I mean, these things are going to be extremely expensive, by the way, but because also their earnings are coming up. But yeah, yeah. Let's see what the 800 strike is going for. So that's kind of, I don't know. And their options, their earnings are the next week, so I bet the implied volatility is even higher. 1 7. Yeah. So since their earnings are the week of, I think they're on the 21st, like you'll notice the implied volatility is higher on these contracts, even though they're further out in date, like in time. It's because their earnings are on that. See, the implied volatility is lower here. And we're going to get into the puts. We're going to get into the puts, but I want to do that separately. So hopefully, hopefully that was helpful. And with that being said, I will see you in the next tutorial video. Maybe I'll have that out today. I'm not sure, but thanks for tuning in, and I will see you in the next one.